Sure. Thank you. Thanks to Equalify team, particularly for hosting us. Good evening, everyone. Very quick introduction about Marcellus. So the firm was founded about 4 years ago, and prior to setting up Marcellus, most of the members of the founding team had been working together for the best part of the last 2 decades. So particularly Saurabh, Pramod, and I have been working together since 2004, and that's one of the bigger strengths of the team here. We've ended up learning and loving what we do by working together over these 2 decades. Today we are managing around 1.7 billion dollars in assets under our care in a PMS avatar. The largest of the 4 strategies that we manage those assets across is called Consistent Compounders, which is the fund that I manage. The most relevant sort of underlying foundation or thematic of our investment approach is that India, we realized 5-6 years ago, India is going through a massive inflection point, which gives a very interesting arbitrage to long-term investors. And the inflection point is that, as the chart on the right shows you, the country is getting polarized. 2 decades ago, India was a combination of several small economies. There would be regional players, niche players. Very few industries would be dominated by pan-India players. Whereas today, most industries the profit pie is controlled by 1 or 2 companies altogether. And the chart on the right shows you that across the entire economy, top 20 corporates, they contribute to more than 60-70% of the entire corporate profitability of the country. The reasons for this polarization are easy to comprehend. To begin with, the country got networked together in terms of infrastructure, so road, railways, aircrafts, etc. But more importantly, in the last 5-6 years, technology and a series of events such as demonetization, GST, and now COVID, they've accelerated the polarization. Now, India is not the only country to have gone through polarization, but India is unique in the sense that whilst other large developed nations which have been polarized are they are rich and they are small. Being rich means there are very few inefficiencies that a great company can benefit from, whereas in India being poor means there are lots of inefficiencies that every industry offers for a high quality corporate to exploit. In India, we also are a large economy, which means that the cash that gets generated by dominating through exploiting a few inefficiencies in every industry, the cash that gets generated, it can be redeployed to deliver growth, right? So it's a combination of high cash generation and high growth by playing through polarization. And we call this an arbitrage because when you're investing in established companies which have a long historical track record, you are not speculating enough. You're not sort of trying to time turnarounds. You're not trying to time macro entry exits. You're not trying to pick up companies which never had any history and might have a great future. You're piggybacking on companies which have had a history, and some of those might also continue to have a great future, and that reduces the risk, the fundamental risk inherent in the investment approach. Now, how do we build the portfolio? So there are a set of filters, and then there's a lot of bottom-up research. The first filter that we do, and this is a big risk mitigating filter, is around accounting fraud detection. We're very paranoid about this. For the last 10 odd years, the team at Marcellus has had its own proprietary fraud detection framework, which we keep polishing and sharpening every year as new information comes in. A quick snapshot of the kind of ratios we use to detect fraud is in the table on the top right. Typically, there are 2 types of frauds that we're trying to eliminate here. One is the sort of more sensational fraud, which is underlying business might be completely hollow, but the promoter or the management might have overstated fundamentals. When this sort of a fraud gets detected, it hits the front page of the newspaper. This is like the Yes Bank, the DHFL, etc. Types of examples. But unfortunately, the bigger issue of fraud, of accounting fraud in Indian equities, is the second type of fraud, where the underlying business might be actually very great, very good, very cash generative, but the management and promoters, they have understated understated the accounts, and that's because of pilferage, siphoning out of money. What this results in is that it doesn't hit the front page of the newspaper, the stock price doesn't crash, it just doesn't compound for you, despite you having identified a high quality business. And hence, the need to identify and eliminate any red flags in accounting practices of the businesses that you invest in is actually paramount in our view. Our most recent book on our philosophy, called Diamonds in the Dust, actually is red meat. You will get a very long list of live case studies and old case studies to understand about how accounting fraud detection is carried out at Marcellus and why it is important in delivering returns. So that's the first filter. What comes out of the first filter is then put through the second set of filter, which is historical capital allocation track record for longer than 10 years should be consistent and healthy. If it is not, then this is where speculation begins in an investment process. We don't want to invest in companies where history either was bad or non-existent or volatile and future might be good. We actually want to invest in companies where history can teach us more about the DNA of the organization, more about the approach, the discipline towards capital allocation of the organization, and using that history, we can build our own assessment of whether the future is going to be great or not. So that's the reason we want revenue growth and returns on capital employed for longer than 10 years historically to be consistent. If it is not, then we don't include those companies in our coverage universe. What comes out of the first two filters is then put through a very rigorous bottom-up research process, and this is, broadly speaking, divided into two parts. The first part of the research is what you see in the on the left-hand side of this slide, which is we want to see our portfolio companies have a lot of pricing power. Now, this is conventional stuff which most investors try to do. The only extra layer of rigor that we add here is we don't define pricing power or competitive edge in the way the textbook defines it. Now, the textbook definition is ability to hike prices when raw material costs go up. We believe that's incomplete. The complete definition of pricing power should be that if you are investing in a company which is selling products at, let's say, 100 rupee price point to its customers, and then a competitor, a rival comes in and offers a 60 or 70 rupee price point for a similar type of a product to the same customer, then will your investee company be able to retain the customer without cutting down on the price? As in, the profitability should not get compromised along with protecting the market share. If that is not the case, if you are investing in a Unilever or a Maruti where every time a Colgate offers a buy one get one free, and a Unilever also has to match with a buy one get one free, otherwise Close Up and Pepsodent lose market share to Colgate. If you're invested in a Maruti where if Hyundai Accent offers 10% extra margin to the dealer, then Swift Desire also has to match. Otherwise, Swift Desire customers move to Hyundai Accent. If that's the kind of company you're invested in, it's low pricing power, despite being dominant. But if you're invested in companies such as, say, a Titan, an Asian Paints, Page Industries, where for a Titan, every jeweler tries to undercut Titan's making charges. For a Page Industries, Van Heusen launched a massive price war 2 years ago. For an Asian Paints, you see every 3 years a new large balance sheet entrant coming in trying to undercount on pricing. 2 years ago, 3 years ago, it was JSW Paints, and I'm sure a couple of years down the line it'll be Grasim. You don't see any impact on either market share or profitability of these companies. So that's the assessment of pricing power that we want to do in our portfolio. Why is it that these companies aren't shaken up by intense competition? The more important aspect of our research process is the right-hand half. That's the non-conventional stuff, and that's actually a lot more juicier. Biggest part of undervaluation of the companies that we invest in comes from here. It's about the sustainability of greatness into the future, right? Whilst it's relatively reasonably well known that the kind of companies that we invest in, the Asian Paints and Titans and Dr. Lal PathLabs of the world, they are good quality. They have high pricing power. Some investors certainly know that. Very few investors, and hence the broader market, appreciate the sustainability of this pricing power into the long-term future. And that's where we make bulk of the returns that we derive for our investors. Sustainability of greatness into the future, we assess via two approaches. One is tangible capital allocation decisions. So last 2, 3, 4 years should be able to convince us about how the existing core competence of a business will be deepened over the next 3 to 5 years. If it is supply chain for Asian Paints, that is its competitive edge. We want to know why in 2025 the supply chain of Asian Paints will be better than it is in 2022. So that's the first type of capital allocation decision. Tangibly, we want to see decisions being made in that direction in the more recent past. The second piece is we want to see our portfolio companies add new revenue growth drivers. Otherwise, if Asian Paints remains a paint company, if Titan remains just a jewelry company, if Jockey remains just an innerwear company, then growth runway becomes limited and competition has a risk of catching up. But if a jewelry company like Titan sort of diversifies into eyewear successfully, into sarees successfully, and diversifies the entire jewelry space through Carrot Lane or wedding jewelry beyond just being the old Tanishq, etc. If an Asian Paints gets into putty, into primers, into sort of waterproofing and services of home decor, etc., then that gives us the conviction that these companies are likely to at least experiment towards sustaining greatness over the longer term. And the third aspect is we want to see our portfolio companies disrupt their industries radically. If that doesn't happen, then it becomes very difficult to sustain greatness as the consumer habits evolve, as the external environment evolves. So that's the first part of assessing elements of sustainability of greatness, and we quantify many of these subjective aspects. One very big subjective aspect is a qualitative aspect, I would call it, is succession. It's the quality of the board, quality of the management team, and the quality of systems and processes at the ground level. If you don't do this, you will probably be invested in a company that is a Lalaji ki dukaan. It runs well today, but doesn't have the continuity and scalability of decision making from the board and management team into the future. We need a decentralized decision making at all of these levels so that it's not that the management is becoming a bottleneck, one person is becoming a bottleneck, and the entire quality, the entire greatness of the business is dependent on one or two people. This is probably the hardest part to, first of all, identify and then quantify. In our research process, we've got a framework to quantify all of these factors, and then there's an interplay of all these risks. Different funds at Marcellus have different combinations of those interplays, which defines the position sizing, the concentration of the portfolio, and absolute valuations of the stocks. So that's the approach. We have a 14 stock portfolio in consistent compounders. At any point of time, we'll have 12 to 15 stocks broadly in this portfolio. The churn in the portfolio is very low. These are the companies which are the non-financial companies. We've sold only 4 companies in the last 4+ years of managing this and bought only 5. So the churn is typically 1 stock a year. The outcome of the portfolio we expect is that all companies invested should compound free cash flows akin to what this chart on the left shows, the table on the left, where whether you look at the last 20 years or the 10 years or any 10 years or any 5 years, the rate at which free cash flows have compounded for these businesses has been stellar. It's at least 20 to 25%, and that then translates 1:1 into share price compounding for all of those years, also being at a similar rate. That's the expectation. We've done that in the last 5+ years and expect a similar outcome over the next, say, 5 to 10 years. Very quickly, what we are witnessing in the current environment after COVID, you can see this is Asian Paints' volume compounding over the last, say, 3 or 4 years for various quarters in the more recent past. These companies have massively benefited from the crisis that has just gone. The benefits are emanating from the kind of capital allocation decisions that they've taken, broadly categorizing into 3 parts. In the last 2 years, M&A activity as one of the ways to allocate capital has been abnormally high. This is not a portfolio that in normal times will grow inorganically. These are companies which have always grown organically. But you can see here, Pidilite acquired a stronger competitor, Araldite. Dr. Lal acquired a new geography player, Suburban. Asian Paints made acquisitions in a couple of new product category areas in home decor. HDFC Life and ICICI Lombard acquired their competitors. The M&A activity frequency and quantum has been abnormally high here the last couple of years. Secondly, many of these companies have accelerated investments around technology. So whether it be automation of their supply chains, demand forecasting, robotics in their manufacturing, and this tech investment has already started yielding results. So Page has doubled its network of multi-brand outlets that it caters to, from 55,000 2 years ago to more than 115,000 today. Asian Paints, despite already being a more than 50% market share controller 2 years ago, has increased its dealer count from around 90,000 2 years ago to 150,000 now. And this expansion of the product portfolio, of the network footprint, can't be possible for large companies like these without enough tech investment. And that then leads to the third type of capital allocation decision that many of these companies have taken. They are transforming their entire industries from traditional businesses to new age. Rather than sort of trying to invest in fintech, Bajaj Finance is a much better proposition, where 2 years ago it was a lender, and today it is transitioning into a complete fintech player. Asian Paints 2 years ago was a complete product provider, and today it is transitioning into a services provider. And these disruptions is what gives us the confidence, the conviction about the sustainability of their free cash flow compounding over the next few years. Finally, what do we do if we don't churn the portfolio much? Every time there is volatility in share prices, we try to benefit from those dislocations. For instance, in the last 6 months, we've not changed anything in the list of stocks that we've held in the portfolio of consistent compounders. But when Dr. Lal Path Labs fell by around 40% due to some news around Tata 1mg, etc., we bought it by the bucket loads. And to buy more of Dr. Lal, we shaved off a couple of percentage points each from stocks which had actually run up. When Titan fell more recently, when there was news around customs duty hike from 7.5% to 12.5% on gold, Titan's share price fell, and we bought it by the bucket loads again. 2 years ago, we did exactly this, which the table below shows you. Bajaj Finance had fallen during the COVID crash far more than the rest of the portfolio. And we shaved off from stocks such as Nestle and Abbott at that time to buy more of Bajaj Finance. And within 6 to 12 months, it yielded handsome results. This sort of an activity actually adds around 2.5% to our long-term compounding. Other than that, it's a pretty boring, very simple, but highly rewarding approach towards investing. So this is the performance in the longer run historically. When you look at the 3 years or 4 years, these performance charts, they don't include July as a month, which itself was a 14-15% growth in the portfolio NAV and outperformance of around 5-6% over the last 1 month. So when you include that, the numbers look even prettier over the longer term. Shorter term had been a little disappointing, but that had its own non-sustainable reasons, which are now reversing, as I mentioned. The returns in the last couple of months are pretty healthy in absolute and relative terms. So I'll stop here. I hope I haven't exceeded the 15-20 minutes timeline given. Thank you for listening, and back to you.